Welcome to Darke English. If you want to improve your English proficiency, please follow us. Here you will learn comprehensively through various stories, news, and other content, which will be presented slowly and clearly. You will gain more confidence. Let's start our journey.
The impact of Fed rate cuts on the U.S. and global economy. Hello everyone. Welcome to today's listening practice. Today we're going to talk about a hot economic topic: the impact of Federal Reserve rate cuts on the U.S. and global economy. Don't worry if you're new to this. We'll use simple words and clear explanations. Let's start with the basics first. What is the Federal Reserve and what is a rate cut? First, let's get to know the Federal Reserve. The Federal Reserve, often called the Fed for short, is the central bank of the United States. Its main job is to keep the U.S. economy stable. Like a doctor for the economy, one of its most important tools is changing the federal funds rate. The federal funds rate is the interest rate that banks charge each other for short-term loans, usually overnight. When the Fed cuts this rate, it means banks can borrow money from each other more cheaply. And when banks' costs go down, they usually pass this benefit to businesses and regular people by lowering the interest rates on loans, like business loans or home mortgage loans. Why would the Fed do this? Usually, it's a preventive measure when the economy shows signs of slowing down. For example, if job growth slows or people start spending less, cutting rates can stimulate the economy. It's like giving the economy a gentle push to keep it moving. Let's take a recent example. In October 2025, the Fed cut the federal funds rate by 25 basis points. That's 0.25 percentage points, making the rate range 3.75% to 4.00%. This was the fifth cut since September 2024. The main reason? Signs that the job market was cooling down. Even though some key economic data was delayed because of a government shutdown, other indicators showed that fewer jobs were being added. So the Fed acted to prevent the economy from slowing too much. How do rate cuts affect the U.S. economy? Now let's focus on the U.S. first. Rate cuts have both short-term benefits and long-term risks. Let's break them down one by one. 1. Short-term benefits for businesses and consumers. The most direct effect is lower borrowing costs. For businesses, if it's cheaper to take out loans, they're more likely to invest in new projects, like building a new factory or buying new equipment. This can create more jobs. For example, a small restaurant owner might borrow money to expand their space, which means hiring more waiters and chefs. For regular people, lower rates are good news too. If you want to buy a house, the mortgage rate might go down, making your monthly payments cheaper. Or if you have a credit card with a variable interest rate, your monthly bill could be lower. This leaves people with more money to spend on other things, like buying groceries, going to the movies, or traveling. When people spend more, businesses make more money, and the whole economy grows. The stock market also usually reacts positively in the short term. When rates are low, investors are less interested in putting money in low-risk investments like bonds, since their returns are lower. Instead, they turn to stocks hoping for higher profits. So after a rate cut, we often see the stock market go up, especially for growth companies and small to medium-sized businesses. But remember, this growth can be temporary if the economy doesn't actually improve. Another benefit is for U.S. exports. When the Fed cuts rates, the U.S. dollar tends to become weaker compared to other currencies. Why? Because lower interest rates make dollar-denominated investments less attractive to foreign investors. A weaker dollar means U.S. products like cars or wheat are cheaper for people in other countries to buy. This can boost U.S. exports and help American companies that sell goods overseas. 2. Long-term risks to watch out for. But rate cuts aren't all good. They can bring long-term problems. One big risk is inflation. Inflation is when the prices of goods and services keep going up over time. If rates are too low for too long, there's more money circulating in the economy. When people have more money to spend but there aren't enough goods to meet the demand, prices go up. A worse scenario is stagflation. When inflation is high but economic growth is slow, and unemployment is also high. This is a nightmare for economists because the usual solutions don't work well. For example, if you raise rates to fight inflation, you might slow the economy even more. The Fed has to be careful not to cut rates so much that it causes stagflation. In 2025, some experts worried about this because inflation was still higher than the Fed's 2% target, while job growth was slowing. Another risk is asset bubbles. An asset bubble is when the price of an asset, like stocks or real estate, rises much faster than its actual value. Low interest rates make it easy for people to borrow money to invest, which can push up asset prices too much. When the bubble bursts, prices drop suddenly and many people lose money. For example, the 2008 financial crisis was partly caused by a housing bubble that formed because of low interest rates. High debt levels are also a concern. When borrowing is cheap, businesses and people might take on too much debt. If the economy slows down later, they might not be able to pay back those loans. This can lead to bank failures and a bigger economic crisis. In 2025, U.S. businesses already had high levels of debt, so more rate cuts could make this problem worse, especially for industries like real estate and retail, which rely heavily on borrowing. There's also internal disagreement at the Fed about rate cuts. Not all Fed officials agree on when and how much to cut rates. Some officials, called hawks, are more worried about inflation and prefer to keep rates high. Others, called doves, care more about the job market and want to cut rates to stimulate growth. In the 2025 rate cut meetings, there were dissenting votes. Some officials wanted a bigger cut, while others opposed the cut entirely. This disagreement can make the Fed's policy less predictable, which can confuse markets. How do Fed rate cuts affect the global economy? The US dollar is the world's most important currency, so Fed policy doesn't just affect the US. It impacts the whole world. Again, there are both positive and negative effects. 1. Positive effects on emerging markets. One of the biggest beneficiaries of Fed rate cuts are emerging markets, countries like India, Brazil, or Indonesia. When U.S. rates are high, foreign investors tend to put their money in the U.S. because they can get higher returns. But when the Fed cuts rates, U.S. investments become less attractive. So investors move their money to emerging markets, looking for better profits. This capital inflow can help these countries grow by providing money for businesses to expand and creating jobs. Fed rate cuts also give other central banks more room to adjust their own policies. When the U.S. has high rates, other countries might be afraid to cut their own rates, because that would make their currencies weaker compared to the dollar and cause capital to flow out. But when the Fed cuts rates, other central banks can cut their rates too to stimulate their own economies without worrying as much about capital outflows. For example, after the 2025 Fed cuts, many Asian central banks were able to lower their rates to support their economies. A weaker U.S. dollar also helps countries that have debt denominated in dollars. Many emerging markets and developing countries borrow money in dollars because it's a stable currency. If the dollar weakens, it becomes cheaper for these countries to pay back their dollar-denominated debt. This reduces their debt burden and lowers the risk of a debt crisis. 2. Negative global impacts. But Fed rate cuts can also cause problems for the global economy. One major issue is global inflation. As we mentioned earlier, a weaker dollar makes U.S. exports cheaper. But it also makes commodities like oil, gold, or wheat that are traded in dollars more expensive for other countries. For example, if oil is priced in dollars and the dollar weakens, countries that import oil, like most European and Asian countries, have to pay more for it. This can push up their domestic inflation rates, which is called imported inflation. Another problem is volatile capital flows. While emerging markets get more capital after Fed cuts, this capital can be hot money. It moves in quickly but can also move out just as fast if the economic situation changes. For example, if investors suddenly worry about an economic crisis in an emerging market, they might pull their money out overnight. This can cause the country's currency to crash and lead to a financial crisis. In the past, countries like Thailand and Argentina have faced this problem after changes in Fed policy. Policy differences between countries can also cause tensions. When the Fed cuts rates, some countries might feel pressured to take action to prevent their currencies from appreciating too much. A stronger currency makes their exports more expensive, which can hurt their economy. So they might intervene in the foreign exchange market or use other policies to weaken their currency. This can lead to currency wars, where countries compete to devalue their currencies, which is bad for global trade. Let's take a concrete example from 2025. After the Fed cut rates in October, the price of gold rose to a record high of over $3,700 an ounce. Why? Because gold is seen as a safe investment when the dollar is weak and inflation is a risk. But this also pushed up the cost of jewelry and industrial products that use gold. At the same time, oil prices went up because of the weaker dollar and ongoing geopolitical conflicts. This made gasoline more expensive for people around the world and added to inflation pressures. What does the future hold? So will the Fed keep cutting rates? It depends on the economic data. Fed Chair Jerome Powell has said that the Fed will make decisions based on economic indicators like job growth, inflation, and GDP growth, not on political pressure. In 2025, there was a lot of uncertainty because some key data was delayed, and Fed officials had different opinions on the future path of rates. For investors and regular people, the key is to be prepared for both possibilities. If rates keep falling, it might be a good time to consider buying a house or investing in stocks, but always be careful of bubbles. If rates stop falling or even rise, it's better to focus on paying off debt and saving more. For the global economy, countries need to work together to deal with the effects of Fed policy. Emerging markets should strengthen their financial systems to handle volatile capital flows. Developed countries should coordinate their monetary policies to avoid conflicts. And all countries should keep an eye on inflation and debt levels to prevent crises. Let's recap. Today, we learned that the Fed cuts rates to stimulate the U.S. economy by lowering borrowing costs. For the U.S., this brings short-term benefits like more investment, higher consumer spending, and a boost to exports, but also long-term risks like inflation and asset bubbles. For the world, Fed rate cuts can help emerging markets get more capital and give other central banks policy room, but they can also cause global inflation and volatile capital flows. I hope this explanation helped you understand this important economic topic. Remember, economics is all about balance. Every policy has pros and cons. Thanks for listening and see you next time.
Thanks for watching. If you like this program, please like and subscribe to it. If you have any better suggestions for us, please leave a message in the comments section below. We will seriously consider and respond to your feedback.